So welcome to this live tutorial called Sustainability Bitesize. Sustainability is now a big part of the SBR exam, and it will be an even bigger part as we move into the new syllabus area from September 27. So sustainability was introduced a year ago now, and it's obviously been tested in the recent sittings. It's all about two standards. So let's have a look. What is sustainability all about? So why is sustainability important? Well, investors are increasingly interested in entities that are sustainable. Hence the reason we've now got these new sustainability standards. Basically, some investors will employ screening tactics, eliminating those companies that exhibit specific characteristics. So things like low pay, high levels of gender inequality, or they source their energy from fossil fuels. Investors don't want to necessarily invest in those companies which employ those tactics. So therefore, sustainability reporting has become top topics and needs to be put into those financial accounts, clearly identifying how you're trying to be sustainable as a company if you want to have investors that find that something as top as their list, of course. So, Sustainability 1 and 2. In 2023, the first ISSB standards were issued, and then IFRS S1, general requirements for disclosure of sustainability and financial information, and IFRS S2 were climate-related disclosures. So they are set by the Sustainability Standards Board, not the Accounting Standards Board, okay? They're adopted by any listed or private company on a voluntary basis. You must know that it's voluntary. But there is no ISSB mandate to apply the standards. So it's not mandatory, but it's good practice. So the general requirements is governance. What are your governance processes to monitor and manage sustainability risks and opportunities? What's your strategy to doing it? What's your risk management process? How do you identify any risks, assess and monitor them? And you must have some metric and targets to be able to monitor and assess. And you need to also make sure you include progress to those targets. So these are all set in place as a general requirement, but obviously there are specific requirements. Now, how is the Sustainability Board and the financial reporting? How are they linked? Well, both sets of standards use the same two fundamental characteristics of useful information. They use relevance and faithful representation, as well as the same four enhancing characteristics. The definition of materiality is also the same. Information is material if it's omitting, misstating, or obscuring information that could reasonably be expected to influence decisions of the primary users, and general purpose financial statements to make the basis of those reports. Remember, materiality isn't just quantitative, it's qualitative. So disclosures are really important in influencing the decisions of the primary users. Both sets of standards identify the same primary user, and the reporting for sustainability-related information has to be the same as the financial statements. So they should be yearly. Risks and opportunities need to be identified, but we need to outline the effect on the financial position, performance, so that would be the profit and loss, and the statement of cash flows for the current reporting period, but also show the effect in the short, medium, and long term. And we must provide information about the resilience of the entity's business model to climate-related changes. So scenario analysis is an important part of this. What if? What if? What does that mean? It means, what if this changes? What if that changes? What if we have a flood? What if we have a hurricane coming through? What have you put in place to make sure things are going to continue? Then climate-related risks will fall into two broad categories: physical risks and transition risks. Physical risks are what they say is on the packet. It results from weather-related events like floods or droughts. It can result from longer-term climatic changes. For example, rising temperatures may lead to rising sea levels, as well as the loss of biodiversity. So that's a physical risk. A transition risk results from a move towards a low carbon economy. So how are you going to get there? Okay. Any laws and regulations that are constantly changing will increase your compliance costs with getting there. So those are your transition risks. If things are going to keep changing and you need to keep changing to comply with it. Then we've got physical risks, transition risks, and opportunities. Here's an example for you, and it actually comes from the ACCA technical article. So this is disclosure of climate-related risks and opportunities facing an international restaurant business. So the types of disclosures for physical risks, they're saying here they rely on large quantities of raw materials, and there could be increased levels of flooding due to climatic change, which would affect the quantity and the quality, also leading to price volatility. Some of the restaurants are heavily impacted by water shortages and chronic weather events. These can cause temporary closures. So those are our physical risks. The transition risks are things like, as I said before, climate-related laws and regulations are regularly changing. As the restaurants operate in more than 90 countries in the world, compliance costs are high. Then many of the customers may pay close attention to our climate-related strategies and targets. If these are deemed insufficient, then our brand value will decline. So these are transition risks as opposed to physical risks. So make sure you understand those. Opportunities. To achieve our goals, we're pursuing a more efficient operations through investments in new technologies. And this means they're going to expect a significant decline in energy usage. So there's our opportunity, moving towards using less energy. Hopefully it's quite clear the three different ways of disclosing those risks and opportunities, relating it to something that we know, i.e. a restaurant business, which is multinational. So now we've got metrics and targets. So entities are required to disclose metrics and targets that will help the primary users understand its performance in relation to climate-related risks and opportunities. So there are goals set by organisations, obviously. Maybe they want to reduce their energy usage by 50%. Maybe they want to convert to green energy. Maybe they're going to set some share-based payment schemes for their directors. These need to be set, clearly identified, and they need to be monitored and measured on their achievability and how we're doing against them. So IFRS S2 states that this involves providing information about any climate-related targets the entity has set, as well as information about its greenhouse gas emissions. Okay. So here is a disclosure on greenhouse gas emissions, again from the technical article. You have to disclose scope 1, 2, and 3. Well, let's see what they mean. Well, scope 1 cares from sources that are owned or controlled by the entity. So what we're causing as a direct cost of manufacturing. Indirect, which is scope 2, will be from the emissions from the generation of purchased or acquired electricity. So what we've acquired from outside. So really we should be good if we start acquiring green energy. That would become quite low. Scope 3 is what is happening in our supply chain. How are we getting things to our factory? How are we getting things to our customer? Is that creating emissions too? So you can see scope 1 is probably easy to identify, and scope 2, but scope 3 is probably harder to identify. So for some industries, scope 3 emissions can account for almost 90%. For this reason, scope 3 emissions are sometimes perceived as a hidden risk, and they're difficult to identify. But by disclosing Scope 3, it will give a more complete picture of the impact to investors. And also you can compare it with lots of different entities' impacts from their different business models. So everybody clear that Scope 1 is what you cause. Scope 2 is what you purchase in, i.e. energy that's been directly bought from somebody else who's causing emissions. And Scope 3 will be what is in your supply chain into the factory or into the business and going out. So here is an example of metrics and targets. First of all, disclosure of the gross target is required as well as the net. This is because the reduction in net greenhouse gas emissions can be achieved through the purchase of carbon credits. Number 2, they disclose their planned use of carbon credits to achieve a net greenhouse gas emissions target. And this is important because some carbon capture technologies may prove ineffective, or there might be a change in regulations which ban entities from using certain schemes. And then disclosure of meeting or not of the targets and the metrics. And this is important as they may be unattainable and set to attract investors. Yeah, because if you set high targets, that will be attractive to investors, but maybe you're never, ever going to achieve them. Okay. So as you can see with the disclosure, it does go on about the company aims to reduce water consumption, but they're behind schedule. They also plan to reduce net carbon dioxide emissions from a baseline, and we will reduce the gross emissions by 10%. And then they go on to say these credits generated from projects that use technology to capture it. Okay. The carbon credits have been independently verified. We are behind schedule on our gross target, but have implemented a new executive management share-based payment scheme, which will vest if the goal is achieved. So they're trying to encourage the directors to focus on this sustainability and these emission targets. So remember, there is a difference between carbon capture and carbon offset, and you need to disclose that too, because capture obviously takes it out of the atmosphere, whereas offset, you're just buying credits. So now I wanted to look at a quick exam question that's been disclosed to us, because obviously there are other exam questions out there which haven't been disclosed. This is one that's been disclosed to us from 2024. So first of all, the question was for 25 marks, and we're just looking at 14 marks, which relates to sustainability reporting. So it says, first of all, briefly discuss how the materiality approach is different to the European sustainability reporting standards compared to the IFRS sustainability disclosure standards. You're not needed to refer to any exhibit when answering part A. So this is pure knowledge for 2 marks. You're either going to know it or you're not. Now, SBR now is only IFRS standards and Irish standards. There's no UK standards anymore. And so it's the international exam that you'll probably be taking unless you're required to take the Irish exam. Now, the Irish exam, you do need to know a lot more about those European sustainability standards because they're part of Europe. But in the IFRS exam, you're only supposed to know the differences. So that's the only bit that we will be looking at. And so just as providing an answer to this question, briefly discuss how the materiality approach is different. Well, here we are, materiality approach. IFRS is about financial materiality only, whereas the European standards has double materiality, meaning materiality is considered on both financial and an impact basis. So that would be your answer for 2 marks, simply explaining that. Then the other differences you need to look at are materiality assessment, the location of the reports. With European standards, it's prescribed to be structured within the corporate reports. There's no prescribed approach with IFRS. Sector-specific disclosures are included with the sustainability standards, but they're yet to be developed with the European ones. And then you've got enforceability. It's voluntary, whereas theirs is mandatory, remember. Scope, it's suitable for all profit-orientated and public sector entities, whereas the European ones are large EU entities, large non-EU entities listed on an EU market, and EU small, medium-sized entities. The target users are the primary ones with IFRS, but there's a wider range of users with the European standards. And then the coverage, we only have 2, but they have 12. So you're very lucky to be doing international financial reporting standards rather than the European ones. So hopefully it's clear that's all you need to know, the differences. So we've answered those 2 marks through a knowledge base. So learn these differences because it's a nice 2 marks to get if it comes up again, but it won't be about materiality, it will be about one of the other differences. Now we come on to the main question. So the main question is now part A2. It says, using Exhibit 1 only, discuss why Kimmler Company's sustainability report does not comply with IFRS sustainability disclosure standards. Read that again, does not comply. So your whole focus of this question is to focus on why it doesn't comply with them. We've just been through the elements of the standards, what's required in the report. So your knowledge that you've just gained from this little lecture should help you in answering this question. Now there are 10 marks, so what we need is to make is 10 points, but you're also going to get 2 professional marks for the clarity of the answer, i.e. writing clearly about why it doesn't comply, not about why it does comply, and for the specific use of the IFRS sustainability disclosure standards, i.e. referring to the standards and at what particular part of the standards that you are looking at. So always saying, as per the sustainability disclosure standards S1, S2, they require metrics and targets would be a good way of making sure you get those professional marks. And making sure that you talk about why it does not comply is also giving you that professional mark. Hopefully that's clear to everybody. Well, let's have a look. How are we going to pick up these 10 marks and then the 2 professional marks should come? So Kimmler has produced a sustainability report. The report states it's been produced in accordance with the sustainability disclosure standards. Due to a systems issue, however, Kimmler was not able to capture important data during December. So the sustainability report covers the 11 months. Does anybody know what is wrong with that? Why does that not comply? Does anybody want to write in the message to let me know? Give somebody a chance. Jessica, it doesn't cover the full financial year. Absolutely. So it doesn't cover the full financial year. So it should be 12 months to match with the financial statements. So there's 1 mark to discuss that. Then it says it's climate-related disclosures. Kimmler has identified several climate-related opportunities. It does also identify climate-related physical risks, but no other types of risk. Does anybody remember what other types of risk I talked about? I talked about opportunities, physical risks, and other types of risks, and 1 other type of risk. Does anybody remember what it was? Not quite. Not quite transaction risk. But thank you for answering. Does anybody get it? It still begins with tran. That's how it goes. I think it's transition risk. Yeah, well done. Transition risk, brilliant. Okay, so we need to talk about the specifically, it's a transition risk. You can't just say it needs to identify all other risks other than physical risks. That wouldn't show knowledge of sustainability standards because you should know it's physical risks and transition risks. Brilliant. For the risks and opportunities identified, Kimmler has disclosed the potential impact on its financial position and financial performance over the next 12 months. What did I say it needed to disclose? Its impact on its financial position and performance, and what else? Anybody got any ideas? What 3 statements do we produce? Statement of financial position, statement of financial performance, and statement of... Excellent answer. Cash flow. Brilliant. And also, do you think we should be looking at the next 12 months only, or should we be looking further ahead? I'm going to give the answer. So here we have cash flow over the short, medium to long term. So 2 marks could come from this, and looking at cash flow and looking at it all over the short, medium to long term. So therefore, 1, 2, 3 marks coming from discussion of item 2. Hopefully you're seeing how you can pick up your marks by not actually knowing very much about the sustainability standards, but letting the scenario and using your head a little bit. As long as you've read the technical article or gone through my bite-size sustainability lecture. Next one is Kimmler has disclosed scope 1, but it's not disclosed scope 2 or scope 3. On the basis of these figures are difficult to measure. You've guessed it, we need to say that they should be requiring scope 2 and 3. And in fact, 3 are considered hidden costs and can represent 90%. It's important to give a bit more depth to that answer, saying why it's important, because scope 1 is just what they create, scope 2 is what they purchase in, and scope 3 is in their value chain. Then it says, they're saying it's difficult to measure. Well, Kimmler's company believes that the level of measurement uncertainty would not be useful to the primary users of the financial statements. Well, that's rubbish, because just because it's difficult to measure does not mean we shouldn't disclose it. The approach and the assumptions can be disclosed. Let the users decide. That's not a valid excuse. So 2 marks coming from that. Then several years ago, Kimmler introduced a share-based payment scheme for its directors. It said it was going to cut scope 1 greenhouse gas emissions by 10% a year on average. This target was not met. The scheme did not vest. No mention of this share-based payment scheme in the climate-related disclosure. So you've guessed it, you need to lay out why, though. All climate-related targets and metrics should be disclosed, and they need to say why they have not been met. Okay, so that is important. So another 2 marks for discussing that. And then finally, the climate-related disclosure details Kimmler's target of becoming net zero within the next decade. Around half of its anticipated carbon reduction is estimated to arise from carbon credits. There is no reference to the use of carbon credits in the disclosure. So of course you can say we should be disclosing the use of carbon credits to achieve the net position. But you can talk about the net position from the gross position, because we also need to disclose our gross, and we need to disclose the types of reduction or removal. So is it carbon capture or carbon offset? Is everybody happy with that? So if you toss up the marks, you should be getting around 10 marks for writing about all that. So even if you only did 4 out of those 7 boxes, you will be getting a good section of this done well, and hopefully be getting those professional marks. The good thing about having to critique something that's there is the answer is in the question, obviously. And if you've read the technical article or done this lecture, then you will be able to assimilate some of the information and use it in your answer, because you'll get some ideas from the scenario, hopefully. So I've got a question on carbon credits. Please, could you explain the terms of carbon credits? So carbon credits is where basically things like where you plant trees. So you pay to have trees planted, and then you get issued with carbon credits because those trees are going to be taking carbon dioxide out of the atmosphere. So that would be classed as a carbon credit. Or you buy other people's carbon credits, and that would be called carbon offset. Do I have any more questions on my sustainability bite size? I'm probably going to stop the recording. So if I put this on my YouTube channel, you don't get to listen to the questions. But please think about joining my course in the future.